Hi guys, welcome to this next session in Portfolio Management for CFA Level 2. Today we'll be covering the remaining part of the reading trading cost and electronic market. So in the previous session we covered all the discussion about trading cost. Today we'll be covering all the discussion about electronic market. The entire topic of electronic markets is based on just one basic idea that our markets have now evolved to work on an electronic platform. We use internet. Earlier we used to call our brokers and then he used to call his man on the trading floor, and it was a longer chain. But now all the actions, all the uh, activities related to markets, they are handled electronically. So basically, just because of this change in how the markets operate, this entire part of this reading is talking about all the benefits, all the risks that we have, some newer transactions that have evolved, some newer malpractices that have come to light. So this chapter is just talking about the fact that, well, now we have electronic markets. What are the benefits, risks, some kind of new transactions, all of those. So let's start with the first part itself. The first part is about benefits. Now, I'm standing right in the middle for one simple reason. I've written some benefits down just to make the class interesting. Because of having the markets as, electronic markets now, I want you to pause the video and just write down a few points just to see how many you get right. What are the benefits that we've had due to markets being electronic now? So I hope you've paused it and written it down. Let's look at the actual content now. So we have several benefits given to us. Now, all of these are fairly basic. There is no need to cram what the 6 points are or something like that. I think a basic understanding of whether something is a benefit or not, if you have any sort of experience of trading in the market, investing in the market, you probably already know this. If you don't, then just read any sort of study material once or twice and you'll get hang of it. You don't have to cram these points. So let's look at over. Firstly, we have cost. One of the best things with electronic markets is that it has reduced the cost significantly. For just for a basic example, earlier when there was a lot of human interaction, broker had big staff, and then there was people on the trading floor. All of them had to be paid salaries. Now with the electronic markets, very high volume of trade can be handled with just one particular system. So in terms of cost, the costs have definitely decreased. In fact, if I take example of India, 10 or 15 years back, we didn't have the concept of brokers who would forego their brokerage fees or who would charge zero brokerage fees. Now you have a lot of brokers who charge you zero brokerage if you're investing for long term. So slowly the brokerage costs have started to decrease. And it's not just brokerage, but pretty much every cost that has slowly decreased over time. Then we have an audit trail. Audit trail simply means that because it's an electronic system, everything is documented at every single step. So if in the future we want to check something, maybe fraud activity, or maybe just there's a standard check to see how reliable the markets are. We want to get a third party verification for some things. Then we have a proper audit trail. Every sort of action that is taken by any participant of the market is recorded and documented correctly. Then there's a lower chance of frauds. Now, we still have some frauds in electronic markets in the real world if you look at it, but the chances of those happening is slightly lower. It ties up with the second point itself that, well, now most of the things are documented. Also, if you remember from ethics, we had something known as market manipulation and stuff. So rumor mongering or trading on insider information, so material non-public information. All of those things are now slightly lower in an electronic market system because, well, everything would be documented. Also, at times, there are hidden orders in the market. Hidden orders are the ones which do not disclose full information. They only give you partial information about the trade that is being executed. When I have an electronic system, I know for a fact that because it's a computer that is handling my trade, my order, if I put it as a hidden order, it would stay hidden. Whereas, earlier when it was not an electronic system, I had to tell to a person that it was a hidden order. That itself created a possibility of the information leaking out. So now you have lower frauds. Also, it has eliminated the human errors. So, human errors of inputs or any sort of processing. Maybe you gave a trade for 1,000, but for some reason there was some communication error and the guy on the trading floor executed the trade for 10,000 say shares, something like that. So now it's more accurate. The entire system is slightly more accurate. And you have continuous markets. Continuous markets simply means that market can operate without any sort of breaks. Now, I think current situation of the pandemic is probably the best example of why this is a very big benefit. In this pandemic, we've had almost all economic operations brought to a halt. But globally, most of the stock markets were operating just as normal. You could operate from your home and you could still invest in the markets. Markets were operating just like they would under normal circumstances. So, all of that is a very big benefit of electronic systems that now, because most of the trades are handled through internet and services, it is always a continuous market. You don't need breaks between the markets. So whenever it's the trading hours, it's a continuous market, non-stop, real-time data being updated. The last sort of benefit, and probably the one that most of you guessed and most of you would probably rate very highly, is the speed, latency. The speed of doing transaction has increased massively, exponentially. This particular part, latency, this is given a very elaborate explanation in your syllabus. So when we talk about latency, let me give you an example. If you have an old phone that you bought maybe 2015, 14 or something like that, pick it up, try, doing opening 3 or 4 apps and stuff, and you'll find that it slows down, it stutters. You tap on something, it takes 1 second and then it opens up. That 1 second gap is what we know as latency. So latency is basically the gap between an action being done and its result being provided to you, something like that. Now, in context of our syllabus, latency has one specific meaning. It is the difference between an information being available all the way till a trade happens on that information. So latency is not just about me going to my broker's website, opening my account and pressing buy on a share and me actually getting the share. That is just one part of latency. There are two other parts. So we have three parts to latency. First is information release to public or to the user of the information. So how much time it takes from when an information is released in the public domain all the way to it being available to the user. Look at 30 years ago. You didn't have internet or any of those things in the mainstream. How would people know that Reliance or any other big company has released an annual report? Well, you'll have to wait for the next morning to get some information about it in the newspapers. Right now, Reliance does a conference which is live. So that's the first part of latency. How much time it takes from when an information is released to the public to it actually being available to you or to the user of that information. The second part is the computation part. That how much time would it take for you to incorporate that new information into your financial analysis? So this is one of the reasons why our financial models are created in such a manner that the moment a new information comes in, you can immediately plug in the new information and you hopefully get the desired outputs. So the second part of latency is the computation. Like once I have the information, how much time would it take for me to analyze it and to get to a decision? The last part is the trading speed. So I have decided that I want to buy a share or I want to sell a share. From that decision till me actually executing that transaction in the market, What's the time gap between that? The first and the third one, these are mostly related with the speed of communication. The first is communication from the company or whatever the public source is, from that to the investment public in general. And the third part is the communication from me as an investor to the stock market that, okay, I want to execute a trade. So the first and third are concerned more with the communication speed, whereas the second part, which is how quickly can I incorporate this new information in my analysis, that is concerned more with the computation speed. How quickly can I compute new results? So I hope all of this makes sense. These are the benefits of markets, or you can also categorize them as characteristics. Let's move on to the next part.